Good afternoon and happy Thursday, everyone. This is Scott Wohlers with River Place Capital. It is Thursday, January the 30th. I want to take just a brief minute to discuss what stocks did last week as the equity markets had a positive week with the S&P 500 up 1.74% on the week. The mid-cap index was up nicely as well, up 1.11% on the week. And the small cap index was up nicely, but not as much, up zero point 0.9 or 90 basis points on the week. But that was great and wonderful last week, but then we woke up Monday morning and everything had changed. And we had heard about on Monday morning the advent of a breakthrough of a Chinese company called DeepSeek. They are an AI company that is based out of China who wrote a white pages paper that said, hey, we did everything to build up this platform that's similar to OpenAI's ChatGPT. It's better, it's more efficient, uses less energy, and it only costs $6 million, which caused the market to go into a big sell-off on Monday. Nvidia, the darling of the equity markets that you've seen, was down 17% off of this news, closed the day down 17% off of this news. And the NASDAQ was down over 3%, and any AI or AI adjacent company really got clobbered. And some analysts called it the largest overreaction since COVID, but you saw a huge market sell-off, and so we're still down about 1% off of that from where we were last week at the close of the week last week in the S&P 500. So the market has taken a dip down, but what has been interesting is before this catalyst of this DeepSeek happened, and we can talk for a long time about the validity, if it's true, if you really believe it, it costs only $6 million. But the reality is if we can produce data centers and AI at a cheaper cost, it's not going to hurt the demand for AI. If anything, it's going to increase the demand as it makes it more accessible and affordable. And maybe we get there sooner than we thought. But all of this being said, there had been a rotation going on in the large cap sector anyway from January 1 leading up to this point anyways, and a rotation out of these big growth names into more of the value oriented names, or out of the Magnificent Seven or Five into the 493 or 495 stocks. And that kind of solidified that rotation. And what was so interesting about the day on Monday is you had the NASDAQ down over 3%, but the Dow Jones Industrial Average finished today positive 0.6% or 60 basis points up to the up higher. So what do you do as an investor when you're starting to see market action like this and you see these big ebb and flows in the swings? Well, a lot of the news priced into these large growth names was everything priced to perfection, everything going exactly to plan. Well, this was a wrench in the plan, and you saw the whoosh down because we had been on a straight line up in a lot of these names, so it's healthy to get a pullback there. So what do you do if you hold these names, or as an individual investor, or how do you manage your portfolio through these times of increased volatility? Well, we always talk about diversification being key here, but then there's always the time where it becomes poignant and pertinent to rebalance your portfolio. And what that does is it allows you those names that have risen higher for you, that have risen higher for you in your portfolio, you're not selling them all the way, but you're bringing them down into equal weight with everything else. And then what you're taking is the proceeds from those, and you're buying some of your stocks that have underperformed. So think of it like this way: if you were in the S&P 500 and hitting a rebalance, is you'd be selling those Magnificent Seven names, buying the other 493 names to bring both back into level in equal footing there. So that reduces risk. It also helps protect you on the downside. If you have an overweighted position one way or the other, and then they go down more than the market, that hurts your portfolio worse than the market. So rebalancing is always an essential thing to do when you're headed for potential volatility in the equity markets. And especially when we've had two 20-plus year returns in the equity markets, it's okay to take some risk off the table and rebalance that and allocate that out accordingly. If you have questions about how to navigate that or how to do that in your own portfolio, we'd love the opportunity to speak to you. You can reach us at 904 888-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.